Chapter 24, Property Insurance. Does the presence of property insurance, the presence of a policy, does it protect one from a peril or hazard? Absolutely not. The purpose of property insurance is to protect the property owner from incurring a financial loss should a peril occur. There are various types of property insurance. We will focus in Chapter 24 on homeowners insurance. A homeowner faces two basic types of risk. One is from property damage. If you own real estate, you take the risk that your property may be damaged, whether that's due to a fire or some other catastrophe. And fire insurance is the foundation of property damage policies. As a property owner, you also face the risk of public liability or personal liability. And basically, this is the risk of someone being hurt on your property. So you have a financial responsibility towards others. You have a legal duty to exercise a certain amount of care, and therefore you are liable if you don't exercise that degree of care and someone is hurt on your property. Here are some basic insurance terms. The insured is the homeowner. The insurer is the insurance company writing the policy, and the premium is the payment made by the insured to the insurer for insurance coverage. A homeowner's policy contains the coverage deemed by insurance experts to be the most useful to persons who own the home in which they live. A homeowner's policy protects not just the structure of the home, but also any other improvements on the property. So yes, it includes the house, but it also includes the garage, if there is a shed, possibly a guest house or a pool house on the property. Those structures are covered as well. A homeowner's policy will have two sections. The first section offers protection against loss associated with property damage, and the second section has to do with the liability protection for the insured plus any family members living with the insured. So section 2 has to do with that public or personal liability, the risk that someone will be hurt on your property. Therefore, let's look at a list of things that are covered or not covered by a homeowner's policy. The dwelling, obviously, yes, would be covered by the homeowner's policy. If there is some sort of property damage and the family must live elsewhere, yes, those expenses while dealing with the repairs to the structure, yes, those are also covered in the homeowner's policy. The personal property inside, yes, it's covered as well. What about any cars that you own that are parked in your garage? What if they're damaged by a fire or by a riot, a storm? Well, no, those would not be covered by your homeowner's policy. Your automobile insurance would cover that. What about pets? Are your pets covered by your homeowner's policy? No, they are not. And there are certain valuables that a homeowner may own that would need additional coverage. And we're going to talk about how that is handled in a subsequent slide. In a homeowner's policy, there are certain terms. The peril is the hazard or risk, and an endorsement is a policy modification. That's also called a rider or an attachment. For instance, if you do have certain valuables that you would like covered that are not part of your homeowner's insurance policy, you can purchase a policy modification, an endorsement. Of course, it's going to cost you to pay for that additional coverage via the endorsement. So let's get back to the first section that's found on a homeowner's policy, that which covers any loss associated with property damage. So the New York Fire Form serves as the foundation for nearly all property damage policies written in the United States, and it covers the following hazards: loss by fire, loss by lightning, losses sustained while removing property from an endangered premises. There are various homeowners policies, and what's termed HO1 is the most basic of all the homeowners policies. One policy will cover those three hazards mentioned in the previous slide: loss by fire, loss by lightning, losses sustained while removing property from an endangered premises. But it also covers losses associated with windstorm or hail, riot or civil commotion, smoke damage, damage to your property by an aircraft, damage to your property by vehicles. In a previous slide, I mentioned that if you have a car parked in your garage and it's damaged by a fire or by a storm, that damage would be covered by your automobile insurance. That is true. However, if a vehicle runs off the road and damages your property, damages your home, your shed, any of the improvements on your property, then your HO1 would cover that loss. HO1 policies also cover loss associated with an explosion, glass breakage, vandalism, and theft. This table is reproduced from your textbook, and it's read from right to left. So the basic HO1 policy, which we just discussed, covers losses associated with those 11 hazards or perils. The HO2 policy offers a little bit more coverage in that it offers coverage against those 11 losses in the HO1 plus the additional ones, 12 through 18. The comprehensive homeowners policy, which is known as HO5, covers all perils except, and there's a list there, flood, landslide, mud flow, etc. The difference between HO1 and HO2 is that HO1 and HO2 are named peril losses. The policies expressly say which perils from which losses are covered, whereas HO5 is an open peril or an all-risk policy. And here are some additional policies where, again, HO1 relates to single-family residential homes. It's a named policy, named peril policy. HO2 also offers coverage for single-family residential homes. It offers coverage against more perils, loss associated with more perils, it too is a named peril policy. We have HO3, HO4. HO3 is a combination between the HO2 and the HO5. HO3 also for single-family residential homes, dwellers. HO4 is for renters. It protects the personal property of a tenant in a landlord's structure. So HO5 we covered earlier. That is for single-family residential homes. It is an all-risk type policy, or an open peril, meaning that it covers everything except a list of different perils. So in other words, its coverage is defined by exclusion. HO6 is expressly for condo dwellers. HO8 is for older properties. HO15 is an attachment to an HO3. It even offers more protection than the comprehensive or the HO5 policy, but it is very expensive. So again, for the perils covered, HO1, HO2, those are named peril policies. HO2 in particular is an insurance policy that covers a large number of named perils, whereas HO5 is that all risk or open peril policy. It covers all perils except those that are excluded in writing. So its coverage is defined by exclusion. As in the previous slide, we made mention to the HO4. That's a tenant's policy, so it provides broad farm coverage for the personal property of the renter, of the tenant. And HO6 is that special condominium policy. It covers the personal property of the unit owner, as well as additions or alterations to the unit not insured by the association's policy. Remember that with a condominium we have separate elements and we have common elements. Well, the condo policy, the HO6, that is purchased by the condo owner, it covers their personal property within that unit and any additions they've made that is not covered by the association's policy. For the common elements, the HOA, the Homeowners Association, has a special policy to cover those common elements. Now remember, all of these policies, all of these homeowners policies that were listed a couple of slides ago really have two parts. The first section has to do with loss associated with property damage, and the second part has to do with public liability. So all of these policies have those two parts. So as a perfect segue, public liability is the financial responsibility one has towards others as a result of one's actions or failure to take action. That's also called personal liability. So remember, this is the risk of someone being hurt on your property, and you have a financial responsibility towards those people. Liability coverage has two parts. Medical payments, that's the cost of treating minor injuries for which the property owner may be liable without the need to determine fault. So there is no need to determine whose fault it is with MedPay. The liability coverage may also have some endorsements. Remember, we said that endorsements were policy modifications. One additional coverage that's not in the basic policy might be an inflation guard that an insured may want to include. That's an automatic increase in coverage as costs rise, as the general level of all costs rise. Another endorsement related to liability coverage might be workman's comp, someone that employs people on their property. Workman's comp would pay for their injuries. For instance, a nanny, a housekeeper, a butler. If you employ any of these people in your home, you might want to consider an endorsement for workman's comp. Now, who has an insurable interest in a property? Obviously, the owner does. If there's a mortgage involved, the lender does as well. If you are a tenant, you have an insurable interest. And does the broker have an insurable interest? No, they don't. But all these other parties do. So let's talk about the lender requirements. If a mortgage is taken out to facilitate the purchase of a home, then the lender has quite a financial interest in that property because the property is serving as collateral for the loan. So the lender wants to protect that collateral by any means necessary. So real estate lenders require that the borrower carry fire and extended coverage on the mortgage structures to protect the value of the security for the loan, in other words, to protect the collateral. The lender is not concerned, however, with liability. They are not concerned with the personal property. They are concerned with the real property and protection against any physical damage to that real property. That's what they're concerned with. They're not concerned with public liability nor with your personal property. The lender will also be named on the insurance policy, on the homeowner's policy, along with the property owner, and any checks from the insurance company for damages will be made out to the borrower and the lender jointly. That's to ensure that the borrower doesn't take the check, cash it, and abscond with the money, leaving the lender with collateral for a loan which is now damaged. Lenders also require the insured to cover or to carry what's called guaranteed replacement costs. The property, if the property is located in a flood zone, the borrower is required to carry flood insurance. And if the property owner decides to rent out the home, he or she will have to purchase a landlord policy. So let's say that someone buys a home, lives in it in a while, has a homeowner's policy, everything is copacetic. But then maybe after a few years, the owner of the home decides to lease it out and live elsewhere. Perhaps purchase another home, move in with family, and lease out that home. The homeowner's policy will not cover any property damage or any public liability that occurs. Now the homeowner is no longer the resident, he's now a landlord. So he would have to purchase a separate policy, a landlord policy, to cover for those perils, to cover the financial loss associated with those perils. Let's get back to this idea of guaranteed replacement cost that's required under. So the lender requires coverage of our guaranteed replacement costs. Well, the issue here is that when recovering damage to a building, the building's not new, but the repairs are. So we can have either old for old, where the policy pays only the depreciated cost of the repairs, or new for old, where the policy does pay replacement costs. And lenders require this second type of coverage, new for old. And this is application of the co-insurance clause and how to calculate the recovery of new for old. We take the amount carried by the borrower divided by the 80% of today's cost to replace the whole structure. That ratio is then multiplied by today's cost to replace the damaged portion. That will be the recovery. Some additional information concerning property insurance. Well, getting back to the idea of flood insurance, lenders require this, and as residents of South Louisiana, I'm sure everyone is very familiar with the concept of flood insurance. Flood insurance pays for damage from the overflow of tidal waters. Coverage for this sort of peril is not included in a homeowner's insurance. The only type of water damage that's covered in a homeowner's policy is when an appliance malfunctions, if the improvement has broken pipes, or if water is used to put out a fire. Otherwise, flood insurance will cover all other types of damage from tidal waters. Flood insurance is a government-created program that's available through independent insurance agents. Of course, this program is subsidized by the federal government, and that's what makes policy premiums so very cheap. For all federally related mortgages, if the property is not in the flood zone, then the lender must have a certificate in hand that certifies that the property is not in a flood zone. If the property is in a flood zone, the lender will absolutely require flood insurance. We mentioned earlier about landlord policies. If someone decides to suddenly lease their home, then their homeowner's policy will not offer coverage for perils. Rather, the homeowner now becomes a landlord and must purchase a landlord policy. And if there's a mortgage on the property, absolutely the lender will require this. Again, this is to protect the lender's collateral. In terms of cancellation of policies by the insured, the policy can be canceled anytime because coverage is always billed in advance. You cancel your policy, the insurance company will then send you a check for the time after, for that prepaid portion of your policy. The insurer can also cancel your policy, but that should occur with some sort of notice. Policies can also be suspended if a certain hazard exposure is allowed to increase. Your insurance company can suspend your policy. Some examples of an increase in hazard exposure might be a change in the use of your property or possibly leaving the property unoccupied for an extended period of time. And that just invites vandalism and theft. However, if the insured makes a willful concealment or misrepresentation to the insurance company, so they attempt to conceal a hazard or an increase in a hazard or misrepresents themselves to the insurance company, that would void the policy. In terms of policy takeovers, this is an assumption of an existing policy from a seller to a buyer. To avoid a break in coverage, the insurer, however, must accept the buyer as the insured party prior to the closing. And home buyers insurance. When you purchase a home, the purchaser of a home is protected against the loss due to certain structural defects. And to protect against that, you can get an inspection, and of course, you can buy a policy that will protect against loss due to structural defects. If it's a new home, there is a policy available. That's about a 10-year coverage, and it's usually offered by the builder. And that 10-year coverage is associated with the homeowner's warranty corporation. If you're purchasing a previously owned home, in other words, a used home, there are warranty policies available for a much shorter time period, maybe 1 to 3 years in length, and those are available for the major systems in that used home, like the plumbing, the electrical systems. So here are our terms at the end of chapter 24. Any questions? Let me know.